If you're aiming for financial independence by 2030, SCHD feels safe, but it's slow. Time is your most scarce asset, not yield. Here's the faster path. VIG for growth, DGRO for balanced acceleration, and DIVO for monthly cash flow with a cushion. In the next few minutes, I'll show you exactly what to buy, why dividend growth beats yield chasing, and how to allocate through 2030. And there's one common mistake that quietly adds 3 to 5 extra working years. Stick around, because I'll show you the simple fix and give you a beginner-friendly allocation you can set up this week. Let's keep this simple. A big dividend today doesn't get you to freedom faster. What speeds things up is total return, two parts working together. Price growth, the fund's value goes up. Dividend growth, the cash you get, increases over time. When your money grows faster, you need less saved to reach the same income goal. And when dividends grow every year, they help you keep up with inflation so your spending power doesn't shrink. Now, SCHD is a decent fund with quality rules and a good yield, but lately it lagged the market. The main reason? It's concentrated in a few areas. If you put a lot into energy and consumer staples, you miss long runs in tech and other growth areas. That's called opportunity cost, money that could have grown faster somewhere else. If the market rises and your fund barely moves, you traded time for a feeling of safety. Quick inflation math. A 4% dividend sounds solid, but if inflation is about 3% per year, your real income is barely growing. In 5 years, it buys less. In 10, a lot less. A smaller starting yield with 8 to 10% dividend growth can pass that flat 4% income in a few years and keep pulling ahead. That protects your lifestyle now and later. Sequence matters. Early on, focus on speed. Let compounding run hot. More growth, keep DRIP on, and let dividends buy more shares. Later, when your account is bigger, you can lean more on income growth. If you chase high yield too early, you slow the snowball right when it should be getting bigger. From a FIRE point of view, you need two engines, growing income and a rising account value. Slow and steady feels safe, but if your total return is even 2% lower each year, that gap can add years of extra work. Those bigger quarterly checks feel comforting, until you notice people who chose dividend growth plus appreciation hit their number first. Here's the common mistake. People jump from SCHD to ultra-high yield funds to go faster. That often backfires. Higher fees, lower quality holdings, and dividends that get cut at the worst time. You don't need to gamble. You need better building blocks with steady dividend growth, quality companies, and balanced sector exposure. So, what actually speeds things up without risking the whole plan? Use FAST. Focus on dividend growth, asset quality, sector balance, and tax-smart structure. Why dividend growth? Because 8 to 10% plus annual dividend growth usually beats inflation and raises your yield on cost over time. Simple idea. Income that grows plus a price that grows gets you to financial independence faster than a big but flat payout. Asset quality is your safety net. Look for companies with steady profits, reasonable payout ratios, they're not paying out almost everything, and healthy balance sheets. Dividends paid from strength tend to keep growing through good and bad markets. That's how you avoid value traps that look cheap but can't grow. Sector balance keeps you from getting stuck. Putting too much in one area, like energy or consumer staples, ties you to one outcome. Spread it out. Tech, innovation, financials, capital, healthcare, steady demand, and some energy, inflation hedge. When one lags, another can lead. A smoother ride makes it easier to stay invested. Think total return, not just yield. It's price growth plus dividend growth. Reinvested dividends buy more shares. More shares pay more dividends. Price gains compound on a bigger base. That's the snowball. Costs matter. Lower fees leave more return for you. VIG and DGRO are cheap, which helps compounding. Covered calls like DIVO uses can add income and soften drops, useful if you want monthly cash flow without selling shares. This isn't theory. Use FAST as a quick checklist. Dividend growth near 8 to 10%, quality companies with sustainable payouts, balanced sectors, not one big bet, low expenses. If there's an options overlay, does it actually improve results? Once you have that, the rest gets easier. We can plug in 3 funds that fit: VIG for growth, DGRO for balanced growth plus income, and DIVO for monthly cash with a cushion. Next, I'll show you how to use each one. Let's put FAST into practice with 3 funds that, together, help your money grow faster without taking wild bets. VIG is the growth engine. Why it works? It targets companies with a multi-year history of raising dividends from real earnings power. Think strong margins, durable cash flow, and leadership in their categories. The thing most people miss is that steady 9 to 10% dividend growth compounds your income quietly, while price appreciation does the heavy lifting. What that means for you? The starting yield is lower, sure, but the total return profile tends to be stronger because you're riding businesses that keep reinvesting and raising payouts. Over a decade, your yield on cost climbs while your principal grows. How to use it? Make VIG your core accelerator, especially in taxable accounts. Lower distributions mean fewer tax drags, and more of your return shows up as long-term capital gains. Set DRIP on, so every dividend automatically buys more shares. Each year, sanity check that VIG's dividend per share grew faster than inflation. If not, add a little more to VIG on your next contribution to keep your growth engine ahead of rising prices. Quick win? Automate a small weekly buy. Consistency beats timing. DGRO is the balanced accelerant. Why it works? It screens for companies that not only pay and grow dividends, but do so with sustainable payout ratios and solid balance sheets. That quality screen is your downside defense. DGRO usually yields a bit more than VIG, and the sector mix spreads your bets across tech, financials, healthcare, and energy for inflation protection. When growth stocks take a breather, DGRO's tilt toward quality value helps cushion the ride. When growth runs, DGRO still participates. What that means for you? You get a higher starting income than VIG without drifting into junky yield. DGRO complements VIG by smoothing volatility while keeping dividend growth intact. How to use it? Anchor DGRO in tax-advantaged accounts, like an IRA or Roth, to shelter its higher yield. Pair it 1-to-1 with VIG if you want a simple core. If you're more growth-focused, lean 60-40 VIG/DGRO. Quick win? Set a quarterly calendar reminder to rebalance back to your target mix. Move just 5 to 10%. Small, rules-based nudges avoid emotional switches. DIVO is your monthly cash flow plus cushion. Why it works? Under the hood, DIVO owns quality growth names, then overlays a selective covered call strategy to generate option income, especially useful when markets are choppy or moving sideways. The starting yield is typically 4% plus, and it pays monthly, which makes budgeting easier and reduces the urge to sell shares in a downturn. Covered call premiums can soften drawdowns, giving you psychological ballast to stay invested. What that means for you? DIVO converts volatility into spendable cash without abandoning quality. You're not chasing an 8 to 10% headline yield with shaky names. You're monetizing time and movement on companies you actually want to hold. How to use it. Place DIVO in tax-advantaged accounts to avoid frequent taxable distributions. Assign DIVO to cover specific monthly bills, utilities, groceries, rent, so your essentials are funded without tapping principal. Quick win? Link DIVO's monthly payout to a separate checking subaccount labeled Bills, and keep VIG DGRO on DRIP to maximize compounding. Now, here's where most people mess up. They chase the biggest yield they see and ignore dividend growth trajectories. That's a trap. A payout that doesn't grow can get wiped out by inflation, and worse, it might get cut in the next recession. Another mistake is overweighting one sector. Loading up on a single theme feels smart until it doesn't. VIG, DGRO, and DIVO each diversify differently. Together, they reduce single-bet risk. And timing switches? Rotating everything at once because you saw a scary headline usually backfires. Use rules-based rebalancing, small and steady. Let me give you a simple playbook you can apply today. If you're early in your FI journey and want to maximize growth, go heavier on VIG, moderate on DGRO, and lighter on DIVO. For example, 45% VIG, 35% DGRO, 20% DIVO. If you're mid-journey and want balance with some cash flow, 35% VIG, 45% DGRO, 20% DIVO. If you need dependable monthly income now, but still want growth, 30% VIG, 35% DGRO, 35% DIVO. These aren't absolutes. They're starting points you can tune.
A quick micro story. Last quarter, a viewer swapped a chunk of a high-yield fund into this trio using the quarterly nudge, 10% toward target each quarter. His comment was, "I stopped watching prices every day because DIVO paid the bills and DRIP handled the rest." That mindset shift, income plus growth on autopilot, is what keeps you compounding through noise. And once you nail this trio, everything else clicks. You've got the growth engine, the balanced accelerant, and the monthly cash cushion. Next, I'll show you how to assemble them into a financial independence-focused allocation you can deploy this quarter and keep rebalancing. No guesswork, no gambling. Here's a beginner-friendly mix you can set up this week. 35% VIG, 35% DGRO, 20% DIVO, and optionally 10% SCHD if you want a small value tilt. Why this works? You're blending a growth engine, a balanced accelerant, and a monthly income overlay, so your returns don't depend on one sector or one style winning every year. They zig and zag at different times, which smooths the ride and keeps you invested. What you'll see day one is a blended yield around 2 to 3%. That might feel low, but stay with me. With reinvestment and dividend growth, your yield on cost can target roughly 4 to 6% in 5 to 10 years, while your principal compounds. That's the speed you've been missing. Income that rises while your base grows. Account placement matters. Put VIG in taxable because the lower distributions mean smaller tax drags and more of your return arrives as long-term capital gains. Park DGRO and DIVO in tax-advantaged accounts, like a Roth or traditional IRA, to shield their higher payouts and, in DIVO's case, frequent monthly distributions. That simple tax-smart move can add meaningful after-tax return without extra risk. Your rebalancing rule is simple. Every quarter, nudge 5 to 10% of contributions or existing holdings toward your targets. No big swings, no market timing. If VIG runs hot and jumps above 35%, future buys go to DGRO and DIVO until you're back in range. If the market dips, you're buying the laggard automatically. Classic dollar-cost averaging with training wheels. Cash flow strategy. Assign DIVO to pay specific monthly bills. For example, let DIVO cover utilities, groceries, Or your phone plan. That predictable cash reduces the urge to sell shares in a drawdown. Meanwhile, keep VIG and DGRO on DRIP until your income target is clearly in reach. When your planned monthly income is, say, 80 to 90% funded, start tapering DRIP on DGRO first, then VIG to let cash accumulate for spending. Stress test how this behaves. In down markets, DIVO's covered call premiums can soften the blow, and its monthly checks help you stay calm. DGRO's quality screens often cushion declines better than pure growth. In sideways markets, DIVO's option income shines, while VIG and DGRO still grind forward as dividends grow. In bull runs, VIG captures leadership, DGRO participates broadly, and DIVO keeps paying. That balance creates psychological safety. You're always seeing progress, either through account growth or cash arriving. If you want a simple automation plan, split monthly contributions the same way, 35-35-20-10. If your platform supports auto-rebalance, set it to check quarterly. If not, put recurring reminders on your calendar, March, June, September, December. Review allocations, redirect new money, and make small trims only if you're way off target. One more thing that separates pros from dabblers. Write a one-page investment policy for yourself. State your target mix, your quarterly rebalance range, for example, only rebalance if a sleeve drifts 5 percentage points, what accounts each fund lives in, and your rule for switching DRIP off as income needs approach. Having it written keeps you from making emotional moves when headlines get loud. Now, let's translate this into dollars and dates so you can track whether you're on pace for 2030. Start with your financial independence target. What do you spend each month? If the number is $4,000, the 4% rule suggests a rough nest egg of $1.2 million. That's a back-of-napkin guide, not a commandment, but it gives you a range. If you plan to work part-time or have rental income, adjust down. If you want more margin for healthcare or kids, adjust up. Now build a contribution plan. Decide on a monthly number you can automate, say $1,500. Using a conservative 7 to 8% long-term return range for a diversified equity portfolio, you can estimate a 203 balance band. This isn't prediction, it's a working map. The key is automation. Money leaves your checking automatically right after payday. No decision fatigue.
Your KPI dashboard should be simple and repeatable. Dividend growth rate. Is the combined VIG/DGRO/DIVO income per share growing at least as fast as inflation, ideally 8 to 10% for the growth sleeves? Blended yield. Is your current yield rising as your shares compound? Contributions. Did you hit your monthly automation? If not, fix it this month. Rebalancing intervals. Did you nudge back to target this quarter? Quarterly check-in routine. Pull the trailing 12-month distributions for each ETF and compare to the prior year. If dividend growth lags inflation for VIG or DGRO, consider allocating a touch more to the growth sleeve. If your income need is getting close, flip DRIP off on DGRO first so cash starts pooling, then VIG later. Keep DIVO paying out the whole time because that's your bill matching engine. Build milestone markers to keep you motivated. For example, by the fourth quarter of this year, allocation set, DRIPs configured, monthly contributions running. By the second quarter next year, blended income covers one essential bill. By end of 2026, income covers 2 essentials. Contributions increased with each raise. By end of 2028, DRIP off on DGRO, starting partial income draw. By 203, blended income plus safe withdrawal meets your FI target range. This turns a vague dream into a scoreboard. When the numbers move, you'll stick with the plan. Here's the takeaway. Dividend growth plus total return gets you to FI faster than chasing yield and hoping. Set your VIG/DGRO/DIVO allocation, automate contributions, and use monthly DIVO cash to stay invested through volatility. If you want the advanced version with international and small cap dividend growth add-ons, watch the next video. Subscribe for a monthly FI plan that actually sticks.